Hello and welcome back guys. So in this video we're gonna be taking a look at Nike, a company that is super well known, and I'm pretty sure a lot of people have been potentially looking to add this to their portfolios. Now this is a retailer, obviously a very well known one, but is it a good buy is the question. And it always has to do with the financials, how cheap the stock is, and also how well it has been doing, and it is doing pretty much annually. Now, the first thing that we want to examine is basically the stock price action that has been happening in the past few years. Let's take it back 5 years, and you will see that we're currently sitting somewhere between the mid, the highs and the lows that the company has been in the past 5 years. So while this could be an interesting opportunity, it's not sitting in the lowest it has ever been. And its 1 year high has been 131, so we're currently slightly below that one. Now, of course, we're going to be taking a little bit of a look at the financials as well. Before we do that, let's take a look at our stock news module. And remember, everything that I'm doing here, all our Patreons have access to. So if you are interested, you can visit myinvestorsheaven.com and become one, or just visit the link in the description box below this video. Now, taking a look at the stock news here, I accidentally clicked, you will see that basically there have been some news all around about Nike, and the most important thing, frankly, is sort of like the woke wave that has been going all around, and Nike has been one of the companies that has been participating in that. I believe with basically Dylan Mulvaney, I think, was actually one of the people who was advertising Nike as well. And so there has been a little bit of a backlash there as well, maybe leading to the stock price drop. But other than that, you will kind of see that the company is pretty much sitting tight. Not too many things happening right now. And articles claiming that the stock is potentially on sale, for example, here for Nike. But we will examine that because we don't just trust what is going on. And also, stay tuned because we're going to be taking a little bit of a look at the insiders here, which are a little bit interesting. Now, First things first. So P ratio at 31. You can kind of see that the company was sitting at significantly higher P ratios for the most time, apart from 2019, where we had a decline in the stock price. Generally speaking, it has been sitting at a fairly low compared to the previous year's P ratio. So at some point it was like 60, for example, which kind of leads me to believe that you could easily see this stock multiplying, maybe sort of like doubling in the upcoming years, maybe potentially sitting at a significantly higher P ratio, which is frankly for a retailer quite high already, because it's sitting at 31 and almost 39 here for the price to free cash flow. But again, lower than what it has been in the past, or at least some of its past. It has also been lower actually in the past few years as well. So it's not like it's super expensive, it's super cheap here, but it's not like it's the most expensive it has been. Now, of course, the price to buy, we are going to discover with our discounted cash flow model, which will tell us the full story there. But I do like that the fact that the company is actually pretty much buying back shares and retiring them here, so outstanding shares going down. And they do have a little bit of extra liabilities, but that's not too much compared to the free cash flow. Now, the potentially concerning thing about the company is that it's not growing much. It is a huge company. It's making tons of billions, like many billions. We will examine that in more detail in the financial statements. But, it's not growing that much. 28% in the past 5 years. So you can understand that this is a low growth company. Yet their net income is growing pretty nicely. And the free cash flow a little bit less. But, the profitability of the company overall is doing better. Again, this is not going to be an explosive growth for a company of this sort, Nike, which, by the way, means victory. It's the Greek goddess of victory that it has taken the name from, Nike. If you were not aware about this one, and I happen to be Greek, so I have to point it out at some point, right? That's what the Greeks do. Okay, so the margins of the company, 10% is it sounds low, but for a retailer it could be fine, and it was also even 13% here. So I'm not too worried about this one. This is frankly not terrible here again for a retailer. And retailers, generally speaking, have low margins. They operate on low margins. The thing is, if you are a retailer of high prestige, then your prices could be higher. You could be making some extra margin there. It's like 10%, 11% here that they were making the last 12 months. And the dividend yield that they're paying is 1.1%, 1.2%, little, but easy to pay, easy to pay out. 46% as a free cash flow payout ratio and 36% as a payout ratio compared to the net income. And so this means that even if they took it to like 3%, it's going to be tight, but they should probably be able to pay it, and especially as the company's income increases. Now, I don't think that they will take it there anytime soon. This will probably stay probably less than 1.5% in the upcoming few years. But it always pays to take a look at the dividends tab here. And it's not really a company that we want to take through our stock evaluator like the dividend discount model, because this is not really a dividend company. We are not really buying this company for its dividend growth, because dividend is very little here. However, they do pay it constantly, so they keep increasing it at a steady pace. And again, you could expect and you should expect this to continue happening. Like 3 cents a year is the typical thing that you see here, pretty much almost every year, which is nice to see. At least you know what you're getting, so getting a little bit extra. Now, the financial statements I want to take a look at, and you will see that back in 2018 they were making 36 billion in revenue. Right now they're making 46 billion. So they're increasing their revenue, not bad at all. Again, not explosive growth, but we're looking again at a retailer, which is a company that is not going to be enjoying, more than likely, explosive growths. And the net income from 2 billion to 6 billion, a pretty nice increase, I'm not gonna lie, again, for a company of this sort. And most of its increase actually happened, as you'll see here, back in 2019. Now, the balance sheet of the company, the important things about the balance sheet is basically we want to examine the total equity of the company from 9.8 billion to 15 billion. Just see that the company has been growing in total equity here. And the liabilities are about $25 billion here. And there are some significant liabilities, but when you take a look at the cash flow statement, you will see that the company is making 4 billion in free cash flow, 4.4. That's about a 5 multiple. Again, it's what we talked about in our stock evaluator, in our metrics page, which is here. This is what this calculates. The total liabilities to free cash flow is about 5.6 years of last year's free cash flow to pay back all the total liabilities that the company has, which means that it's a very solvent company. They won't be having problems with money anytime soon, and it's a good way to gauge the company's profitability and viability for the future in terms of a potential bankruptcy if the company is actually having a lot of debt. This is not such a company, though. And I take it back to the cash flow statement here, and you will see that the cash flow statement, the free cash flow of the company has been increasing, but just slightly, from 3.9 billion. At some point it was even higher, and then it reached 6 billion here, and now 4.4. Now, there are tons of reasons why free cash flow could go down, and it has to do with the operating cash flow for the most part and capital expenditures. But since capital expenditures are about the same pretty much every year, what mainly changes is the way they are handling the operating cash flow. And back in 2022 fiscal year, you will see, for instance, they bought a lot of inventory. This is why money was extracted, 1.7 billion here, and inventory was added, meaning that they actually spent cash, and this is why you have an outflow here at the operating cash flow, and you're getting a negative value. But again, generally speaking, the company is doing about similar free cash flow, and frankly, it's closer to 6 billion than 4.4 here. Now, the thing that I wanted to point out here, which I think is interesting, is the insider trades, which I was taking a look at a little bit earlier. You'll see a buy here, which doesn't happen that often. And again, using our tool, you will find exact details here, like the purchase that happened. For instance, here, July 1st, for example, and February 8, 2023, Director Henry Peter transacted here 500 shares about, which is a value of $70,000 of Class B common stock, which means that they actually bought it with their own money. And you see all sorts of different purchases here, which generally speaking, they tend to be options. And again, our tool here can show you exactly what is going on. And the other thing that you want to see is what kind of sales are happening and who is selling, specifically the CFO. The CFO is important to gauge in companies because they know about the finances of the company, of said company. And so if they are selling a ton, it may be a little bit of an alert here for potential investors. And you will see here that the thing that you want to see actually is the securities owned compared to the securities transacted. So you kind of want to see how much they sold out of what they own. And this is again the CFO, the Chief Financial Officer. And you will see that they are selling like 9,000, 5,000, 4,000, but they have a lot more, like 50,000, 56,000. So it's not something out of the ordinary. And you may be wondering, yeah, this one, but over here they transacted everything. But this is an option. So they actually exercise the right to buy. And this is a buy, as you'll see here. But generally speaking, when they are selling, for example, here, they actually sell, you will see that they are selling just small lots, normal lots, what people will sell for compensation pretty much. So nothing out of the ordinary happening here. Interesting to notice. And this is why our tool here can tell you a lot of these things just by taking a look at a very, very simple overview. Okay, so the next one and the final step to see is the stock evaluator, our discounted cash flow model. And the company's revenue growth has been at about 5 to 6% a year. And this is what we're going to use. I'm going to go 4, 5, and 6 for the revenue growth. Now, of course, the company could potentially do a little bit more, a little bit less, but again, the average revenue growth has been 6.6%. So 6 is actually lower than the average, but I think it's fair for our calculations. And you will see that some years were particularly positive here, some other years a little bit more negative, like 2021 was pretty good for the company, but about 6% is the average. Net income margin, again, you will see that the average is near 10%, but we kind of want to go with so we do want to go with, generally speaking, the most recent net income margins because they can be affected year over year. And generally speaking, going with the most recent ones make more sense because in the previous years there could have been multiple reasons why margins were dropped. Like the company could have gone through some, some bad annual statements, for example, or they could have spent more in operating expenses, for example. So we kind of want to go a little bit closer to the net income margins that have been achieved recently. Yet we are going to be a little bit more conservative and go around that. So I'm going to go 12%, 12.5, and 13. And again, using our tool, you can try all sorts of different scenarios. I just have to go with some that make sense here for the video that I'm making. So the free cash flow margin typically is a little bit less than 100%. So I'm going to go with something that is rather typical, generally speaking, like 80, 90, and 100, and 13% for the annual return. So what are we getting here? When I hit calculate, you will see that our highest projection is sitting at about $68. And this is with these projections here, with this scenario over here, 6% revenue growth, 13% net income margin, 100% free cash flow margin, which is basically the same as the net income. And so 67 is very far from the current price of 111, meaning that Nike, while a good company, it's very, very expensive, and I probably would avoid it right now. It would have to go down quite significantly, and especially since it's a retailer, hence, unless a very, very well-known retailer. Still, I would prefer to get it at a much cheaper price, even though it could do well eventually because it has been coming off of a pretty interesting decline. But I think there are better opportunities, and again, a retailer, I would want to be getting it at a cheaper price, significantly cheaper, and this is probably not it. I thought it was interesting, though. I thought it was definitely an interesting one to talk about and make a video about. Because Nike, I mean, a company that everybody would eventually love to have in their portfolio, but the price has to be right, and I don't think that's the right price, frankly. Thanks for watching, guys. I'll see you in the next video. Bye bye.